Hey everyone, welcome to Fellowship of the Frugal. My name is Daniel. In today's video I'm going to look at some of the differences between the three major types of life insurance. We're going to look at term insurance, we're going to look at whole life insurance, and we're going to look at universal life insurance. This is by no means extremely comprehensive. This is just to give some of the very basic bullet points and differences between the three. So if you like what you hear, want to learn more, be sure to leave me some comments, be sure to click subscribe, and I'll be sure to get some more videos out to you that'll hopefully help you on this topic. So I hope you enjoy. Alright, so let's get started with probably what's the most common one, at least today, and that is term insurance. Now this one is very simple, very straightforward. This is just a basic level life insurance that you can get. By term, it just means you are getting it for a certain length of time. There is a term of time that's involved. So it's usually 10 years, 20 years, or 30 years, something like that, or anywhere in between. But you are buying the insurance for a certain period of time, and you're going to pay the premium along the whole way. And at the end, if you're still alive and you paid your last premium, then thanks for that, but now that's all said and done. That's over with. Or the company may let you actually renew it, but it's going to be much more expensive. We're talking over 10 times more expensive if you continue it at that point. So another thing about it is it builds no cash value. So these are like the internal values within the policy that you can take out and benefit from. I'll talk about that on the whole life segment, but it does not build any cash value. So what that means is if you're paying on it for 10 years, you decide you don't want it anymore and you either cancel it or replace it with something, the insurance company says thanks for those premiums, that's it. So you have really nothing to show for it while you're paying on those, and there's no type of equity that's built up within it. So that's it. It's basically like the equivalent of renting. So if you're going into a house and you're the renter, you pay the rent, and then once the lease is over with, then you either got to renew it or go somewhere else. It's the same idea. You're a renter when it comes to term policies. However, they do pay a tax-free death benefit, so that's important, because these are the ones that if you need a lot of life insurance based on where you are in life, but you may not have a lot of spending money to buy the life insurance, term is a great option because you can pretty much get a lot of insurance for much less expensive, at least premium wise, than the other types, and it pays a tax-free death benefit. So if you do pass away during the life of the policy, your beneficiaries will enjoy whatever the death benefit is income tax-free, which is a great thing. So you definitely don't want to discount this because it's a great option for life insurance. You don't want to discount it at all. So that's term insurance. The second type is whole life insurance. Now, this should be pretty straightforward. It gets its name from the fact that once you get it, it's expected that you have it for your whole life. It lasts for your entire life. So this one does build cash value over time. So as you pay on the policy, there is going to be some internal cash value. You can think of it as equity within the policy that you can use for a number of reasons. I'll have another video that really highlights some of those options for you, but for this video, just know that it does build cash value and you can use it for something down the road. This also does pay a tax-free death benefit as well, just like the term insurance does. So whatever that is, just say $500,000. If you pass away during the policy, your beneficiaries are going to enjoy a tax-free death benefit of whatever you set in place ahead of time. And so with this one of the ways it's different from term even still is that you're not locked in for a certain length of time. Since it's meant to last your whole life, if you're paying on it for 70 years and then pass away, there's still a death benefit that gets paid out. Not to mention you probably have a lot of cash value by that point, but you do have options of either forfeiting the policy or continuing it on throughout your lifetime. Again, in another video we'll go into more detail on that, but just know right now that those are the basic things about whole life. So the third type of insurance that I'll talk about is universal life. I know when I was in the industry, we used to joke and call this the perm term or the permanent term. Basically, universal life came out as a hybrid between term and whole life insurance. Quite honestly, it came about as a reaction to the big push for this strategy that is buy term and invest the difference. This provided an option that would give you a lifelong policy without having to necessarily worry about the cash value accumulation, to where if you just want a bare bones basic lifetime of insurance coverage, then universal life became a good option for that. Now, these are very flexible, and there's a lot of ins and outs of this policy, so I'm not going to cover those here. I just want to talk about the very basic points of it. You really want to get with your insurance agent to learn the ins and outs of universal life policies, because you can get into where you underpay the premium, and so the policy will then lapse one day because the values are not enough inside to sustain it against the values that are needed. So you'll have to talk to your insurance agent about that. A lot of them have a guaranteed minimum premium that's guaranteed to keep your policy in force. So if you pay at least this amount, then your policy is going to be with you for the rest of your life, and that's a contractual obligation that you can have the option for depending on the insurance company. And this one also pays a tax-free death benefit. So just like the other ones, any death benefit that is paid to beneficiaries is 99% of the time going to be tax-free. The only time it's really not is if you run into an estate planning type of issue, which that's another topic for another day, and that's high dollar stuff. But for the majority of people out there, the death benefit will come income tax-free. So all three of them offer that, and the reason I keep really emphasizing that is because when it comes to planning for how much life insurance that you need, the death benefit is really the number one force that needs to drive that on the front end. So if you need $1 million in coverage, but you can't afford $1 million in whole life or $1 million in universal life, then get what you can in those, but then also supplement the difference in term. The death benefit is the most important part, because if you're doing a full financial plan and you're planning on living a long time and being able to have all this money invested in all these things, but then that time frame gets cut short because of some reason and you pass away, then you want your life insurance to pay to be able to continue that plan on for your beneficiaries. So make sure the primary reason that you're planning for your life insurance is to make sure the death benefit is what you need it to be. I'll have other videos out of my site that go into more depth about each kind and ways of plan and know which one's better for you and budgeting and things like that. But that's what I wanted to say on this video. Hopefully this helps get you started for looking at the basic differences between the three major types of life insurance. As always, you can leave some comments, send me an email. I'll be sure to respond to you as best as I can. If you have any suggestions on more topics that you'd like to see, be sure to let me know, and I hope you enjoy. Thank you.